First up, we got to start with GM and Ford, both under pressure amid labor contract negotiations with the United Auto Workers.
It should be obvious that the big three cannot afford to cave in to the union's demands because doing business with them will bankrupt them quickly. How many individuals are going to buy cars that cost an average of over $100,000? China will enter the market with an inexpensive vehicle and sell it. Thus, in order to increase revenue, both parties must seriously discuss how to reduce the cost of each automobile while selling more vehicles. In the midst of labor contract discussions with the United Auto Workers, pressure is mounting on both General Motors and Ford. With Walmart expected to release profits soon, the stock surged, marking a fourth record close this month. Chinese ADRs declined due to worries about the country's real estate market. In the midst of labor contract discussions with the United Auto Workers, GM and Ford are both facing pressure. Fears of a strike are starting to surface as the contract's September expiration date draws near. That was evident in both of these companies' weekly movements as well as in today's trading. The idea is that the employees and the unions might hold the upper hand in this kind of climate, at least according to some of the commentators out there. The UAW contract ending on September 14th is the largest immediate danger to GM and Ford, according to a report from Wells Fargo, which also referred to the demands as daring and increased the chance of a walkout. Guys, you know there's twofold. On the one hand, there is the possibility of a strike and the potential financial impact on the auto industry. The understanding that if they do come to a contract, it will result in higher costs is another factor. Bloomberg released a statistic stating that the cost for each of these American automakers will increase by more than $80 billion for these corporations. You don't need to look any further than UPS to see where those additional expenses are going to come from when you take into account what the UAW is specifically requesting at this time in their contracts. They avoided a strike, but as a result of the greater pay, additional perks, and other factors, their expenses increased dramatically. Therefore, it appears that these automakers are in a lose-lose situation when seen as a whole. Investors, however, are undoubtedly not anticipating a strike in this situation. Rather, they are anticipating greater prices as a result of these conversations. Walmart stock ended the day higher, marking its fourth record finish this month. The business is preparing to release its quarterly results the following week. Because of Walmart's mix and the current state of the market, there is a lot of pressure on these outcomes. It was mentioned that Target wasn't a little more flexible. When it comes to fresh goods, which are sort of these core items that customers are currently looking for and increasingly seeking for value, Walmart is in a superior position. You could argue that Walmart has a better foothold in that market and that there are more expectations for its results coming up next week. Yes, there are undoubtedly larger expectations, particularly in light of what these two corporations told us last quarter. Because of Walmart's mix and the current state of the market, there is a lot of pressure on these outcomes. We discussed how Target could be a little more flexible. Given Target's greater reliance on some of those more luxurious items, Walmart is clearly in a healthier position than Target when compared to its current situation. However, credit has maintained its outperform rating on the stock and raised its price objective to $180 this year when it comes to Walmart and what we are anticipating. They have a lot of faith in Walmart's current positioning and the probable shape of the returns. However, we found what Michael Lasser said about the prospects to be interesting. He anticipates Walmart's cautious approach in this area. Although he believes they will be able to weather some of the downturn and some cautious customer behavior, at least in the near future, he would not be shocked if Walmart provided cautious guidance in light of some of those macro headwinds.
I think this earnings season we're going to see a mixed picture of the consumer. The consumer has had to spend more money to buy basic necessities like food, household products, given all the inflation.
Okay, today's decline in Chinese ADRs is also being attributed to renewed worries over China's real estate market. 2 years after the Evergrande Group's insolvency, Country Garden's profit warning has increased concerns about China's real estate market. It's sure you're watching this very closely, but when you look at the losses overall, it really emphasizes how China's economy is currently struggling. The failure of this recovery to gain traction as quickly as we had anticipated, and it goes without saying that some of that has to do with the severe weakness we're currently witnessing in the real estate market. Yes, Country Garden is the last of the major developers that have been able to avoid a default up until this point, which is why we are so focused on them. And when you consider the extraordinary boom China has had over the years, not just the past few, you realize that it has been fueled by the real estate market. These developers are taking on enormous amounts of debt in order to grow significantly. And when Country Garden said that they anticipated a loss of $7.6 billion during the first half of the year, many investors were reminded of what happened with Evergrande, which has significantly rekindled their anxiety. All the major Chinese ADRs, including Alibaba, JD.com, Baidu, and others, are noticeably scaling back. By the way, Country Garden traded in Hong Kong and suffered significant losses on the day as a result of these figures.
Country Garden issuing a profit warning, deepening fears over China's property sector. This coming 2 years after we had the Evergrande Group's default.
According to a study published in the Financial Daily Barron's, shares of General Motors Co., GMN, and Ford Motor Co. FN could increase by at least 25% in the upcoming year, as U.S. auto sales are likely to be greater than many investors anticipate. According to Barron's, both firms' stocks appear undervalued. Ford and General Motors are trading at 6.6 times and 5.6 times respectively, their projected 2016 earnings. The Ford price-to-earnings ratio for the larger S&P 500 is 17. Investor anxiety over both the decline in the U.S. auto market and a slowdown in China's economy has put pressure on the shares of both businesses. But according to Barron's, investors are overlooking a number of advantages. One factor that may increase profitability is that automakers are a lot leaner than they were in past years. Additionally, the journal noted that although U.S. sales may slow from the first quarter's pace of 17 million or more units annually, they are anticipated to settle between 16.5 million and 17 million vehicles annually. Ford and GM have both stated that if annual sales decrease to around 11 million, they would still be profitable. Barron's reported that retired unionized workers are no longer required to pay for their health care. The costs were transferred to a trust fund managed by the United Auto Workers, which was established at a cost of billions to the automakers. On Friday, shares of GM finished at $30.56, and those of Ford at $12.94. Tesla, a company famed for its cutting-edge electric cars, recorded sales of $71.5 billion in 2022. However, Ford and GM, the more staid pillars of the Motor City, outperformed Tesla's shares, with Ford reaching $158 billion and GM recording $156.7 billion. Elon Musk's talent for persistent marketing has helped Tesla reach a market valuation of $870 billion, surpassing that of the next 9 largest automakers put together. GM and Ford, two well-known Detroit companies, are positioned in the center of the pack with a market worth of $55 billion and roughly $60 billion, respectively. This variety of sales and market value figures can make it difficult for investors to choose which automobile company is the best investment. Despite having followed diverse pathways to success, Tesla, Ford, and GM are all leaders in their respective fields. Analysts have classified General Motors and Tesla as moderate buys, while Ford is ranked as a hold. However, based on the average price target, GM stands out as having the greatest upside potential, according to the data. GM has taken the transition to EV seriously and announced intentions to stop producing all combustion-powered vehicles by 2035 and 2021. This dedication extends to plug-in and hybrid vehicles. GM is now using a combination of electric vehicles and flex fuel vehicles. Flex fuel vehicles may burn higher quantities of lower-emission ethanol fuels than traditional gasoline vehicles to achieve its carbon neutrality targets. Ford has publicly said that it will increase its EV marketing and production going forward as part of a wider transition away from combustion-powered vehicles to EVs. The business announced a $50 billion effort in EV investments through 2026 in the spring of last year. That's all for today. If you like this video, please give us a thumbs up. Make sure to subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comments section below. Until then, bye. Also, spend some time watching other videos on the channel.